Hi, everyone. This is Jason Birak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's an investment banker, a financial analyst, a bank analyst, a credit analyst. He has so many different titles, and he's written a number of popular books, including Inflated, How Money and Debt Built the American Dream, and his newest book, which is coming out soon, is Ford Men: From Inspiration to Enterprise. Christopher Whalen, thank you for joining me.
Hey, my pleasure.
Now, Christopher, before we talk about your new book, since you are a banking analyst and there's always news stories about the banks, I'd like to get your insights about the banking system that we have right now. The Dodd Frank bill was controversial when it passed. In your opinion, do you think it's helped the banks at all in the United States?
Well, I mean, the banks in the United States were in pretty good shape to begin with because of the rules we have that require much higher levels of capital than for banks in Europe and Asia. So I think Dodd Frank was mostly a reaction to the financial crisis, and it was really politicians using the rubric of consumer protection and, making sure that the crisis doesn't happen again as a means of enriching themselves. I'm sitting here doing a paper for Indiana State University on this topic. And if you look at the mortgage sector, or you look at other sectors, the billions of dollars that were taken out of the pockets of the shareholders of public companies in the name of, helping the banks or protecting consumers or, addressing various wrongs that were done during the crisis are really a scandal. There's just absolutely no reason for this. The crisis in 2008 happened because of a lack of confidence. Investors ran away because one day they realized that they didn't know what was going on. And that's always how financial crises start. So, Dodd-Frank mandated capital and stress tests, and it gave the FDIC the legal authority to wind up big financial companies, banks or non-banks. And there's parts of the law that make sense. Don't get me wrong, it's not like it's all bad. But I think a lot of it was simply politicians doing what they do best, which is using a crisis to benefit themselves. But if you look at the Consumer Finance Protection Bureau, it's been a scandal. They have done more damage to the mortgage industry in the past 5 years, and hopefully that'll be reversed, under the new administration.
Now, I read Danielle DiMartino Booth. A couple months ago, November, December, she started writing a lot about Dodd-Frank and how she thinks it's been creating basically a commercial real estate bubble because, I guess one of the unintended consequences, actually, I'm not sure if this was intentional or not. Maybe it's unintentional. But, I guess it was trying to restrict the banks taking on as much trading profits and doing as much trading. So instead, the banks started putting more and more money into commercial real estate loans. Do you think then that the Dodd-Frank has helped fuel a commercial real estate bubble again in the United States?
No, I don't. I don't think that's really it. If you look historically at real estate, which is a big asset class, the focus of investors in banks on residential versus commercial real estate has tended to follow a cycle. So last time it was residential, and this time around banks have been very cautious about lending on residential homes. They won't lend for construction, for example. There's no dirt lending in resi. This time around, the focus was commercial real estate, as you say. That's absolutely right. And the Fed, because of their interest rate policies and some other policies, really focused even more on multifamily housing, commercial construction, that kind of thing, especially in the big cities, the big coastal cities. So New York, San Fran, Dallas, Miami, all of these markets took off. While the middle of the country, there was virtually nothing going on. In Chicago, for example, you have almost no multifamily construction in that city, going back years, by the way. So I think it was a combination of monetary policy and just kind of the cycle of Wall Street to find a place to deploy a lot of capital and use leverage. So is there a bubble in commercial real estate? Yes. It probably peaked a year and a half ago, and prices have been softening, especially in high-end residential buildings. And here in New York, for example, the rental market for high-end is very soft, and it's going to get softer. So you have that, and then you also have technology. You have Amazon and all the rest of this, and the millennials, they don't go to malls, they don't drive cars. And so you have real softening going on now in commercial real estate, malls and retail establishments, that sort of thing. So there's a lot of different factors. I wouldn't blame it on Dodd Frank per se, because the regulations that the bank supervisors put in place after the crisis actually constrain commercial lending. A lot of the financing for commercial real estate has actually been done in the ABS market. And my firm, Kroll Bond Ratings, has a very big commercial mortgage-backed securities group that follows all these deals and rates them. And, that's where the money's been raised, not on bank balance sheets. Bank commercial portfolios, it's not that big, actually. It's less than $1 trillion. The book of loans that banks hold in residential mortgages is $2.5 trillion. So the real money in that market is held by investors, who finance it with asset-backed securities.
That's interesting. Now I want to ask you about too big to fail banks. I'm not a banking analyst, but when I look at the American banks and the large European banks, it seems they're a lot larger than they were in 2008. Do you think a lot of important things with the banks with respect to risk and their portfolios, maybe setting aside capital ratios, has been fixed since 2008 to prevent maybe another 2008 financial crisis?
Well, look, more capital is fine, but ultimately what drove the financial crisis was fraud, particularly off-balance sheet financing that was hidden. Citigroup is a great example of this. Citi had been floating a lot of off-balance sheet vehicles and pretending that they were not theirs and that they didn't have to put capital underneath them. And one day, everybody woke up and realized that Citi had much more liabilities than they had been reporting, because these money market funds that had been buying that paper from Citi refused to buy it. They said, here, we want our money back. So Citi failed. And it had nothing to do with the capital of the bank. It was simply that investors lost confidence in the bank and they were unwilling to face them in terms of taking risk or buying their paper. Same thing with Lehman Brothers. Same thing with a number of other institutions that failed. When the market backs away from Bear Stearns, another case in point, firm I worked for twice, there's no amount of capital that's going to save you if you have fraud in the markets, and particularly off-balance sheet financing was by, for me, the most important crisis. So I think that, the capital fixation of the policy narrative has come about because it's very difficult to explain this to members of Congress. They focus on capital because it's easy to understand. My friend Anat Ahmadi, for example, has a wonderful book, about banks and capital and everything else. And I always go back and forth with her because I said, look, you could have 100% capital, but if investors and the public doesn't trust that bank, it's going to fail. That's the reality. So I think capital has become a panacea, and it's easy to understand, easy to explain to people. The regulators like it because it's easy to enforce. It's much more difficult to go after fraud and to really, crack down on practices that undermine confidence. That takes a very different toughness of mind that, frankly, the Fed doesn't have. The Fed's never been willing to go after big banks. That's why too big to fail still exists. And you pointed out, these banks are much bigger now because the Fed, is run by economists, and they lack the courage and the toughness of mind that is required to shut down a bank. The folks at the FDIC are different. They've dealt with bank failures, and they have no illusions about what's required when a bank is insolvent. But too often we've just put them together. You see this in Italy too. We just had a situation with Banco Monte dei Paschi di Siena. Well, back in 2012, a guy named Mario Draghi, who's the head of the European Central Bank now, allowed a merger between that bank and another bank that was insolvent. Well, surprise, surprise. The bank has had problems, right? And I think this is going back years to when I first worked at the Fed. The central bankers, who are mostly economists, just lacked the competency and the courage to deal with financial problems directly. They'd rather sweep it under the rug and leave it for somebody else to deal with years later.
Yeah, those are great points. You brought up fraud from bankers. I mean, we have the Security and Exchange Commission, SEC. They prosecute fraud. We have the Department of Justice. They're supposed to go after the banks if there's fraud. And yet, some of the statements that have come out from those agencies were like, we don't want to spook the financial system, lose confidence in the banks, and that's why we're not going to prosecute. I think there's plenty of laws on the books already, Chris, for fraud among bankers. We had the S&L crisis of the 1980. A lot of banking executives, security and loan executives went to prison for fraud, so the laws are there. And yet, during the last crisis in 2008, we didn't have anyone who committed fraud, and I think there were lots of cases of fraud in the mortgage-backed securities industry. We could probably spend an hour or two talking about that. None of them really went to jail for committing fraud.
Well, that's right, and look at the housing sector particularly. The focus of regulators and the politicians was consumers. They said, oh me, oh my, we had a foreclosure crisis, we have to go punish somebody. And so they extracted billions of dollars from these companies with settlements and monitors and all the rest of it. But they ignored the other piece, which was when somebody took these loans, packaged them in the securities, and sold them to investors. These were acts of fraud, too. And they didn't go after that. As you pointed out, they were afraid the world was going to end if we prosecuted bankers. Tim Geithner and Larry Summers said this repeatedly. But I think just the opposite. When you prosecute fraud and you make people understand that the rules are going to be followed, you actually make confidence stronger. And that's, I think, the terrible lost opportunity of this 10 years, 15 years since the crisis, is that, the state of New York, the feds all dropped the ball because they refused to prosecute people for obvious acts of financial fraud related to securities. It wasn't just consumers. There were consumers who suffered abusive process and other wrongs as part of the foreclosure process, but the numbers were tiny. And if you look at the numbers involved in securities fraud, the amounts of money that were involved, the failure of major banks, and none of these people got prosecuted. Bob Rubin and the rest of them at Citigroup, they just walked away. And I think that's the problem, because if you don't punish fraud, then people will do it again. In fact, one of the things I worry about even today is, where is the game being played right now? Where is hidden leverage in the system that could just explode one day and damage confidence and put us right back where we were in 2008?
Oh, I completely agree, Chris. And it really pisses me off. We see what John Corzine got away with. I think he's paying, a $5 million fine, and he can't be sued now in civil court. And he commingled, stole basically $1.6 billion in customer funds and gambled with the money on betting on Greek debt. So, this is a guy who's politically connected. He committed, many cases of fraud, and he's getting off with it scot-free on a beach somewhere.
Well, no, he's not scot-free. I'll tell you what I think happened there. First off, the trustee in the bankruptcy for MF Global was able to bluff their way into getting full recovery for the creditors. So once that happened, there really wasn't a predicate for suing the guy, even though, sure enough, he had commingled funds. And that's very typical with broker-dealers in the commodities markets. And, he, as I recall, in the most recent announcement of the settlement, he's been banned from the industry, which is not a trivial thing. He's basically no longer able to work in his chosen profession. So I think, he has certainly suffered publicly, and I think everybody knows what happens. It was a mistake. But, could he have been taken to task in a more stringent way, I suppose? I know a lot of the creditors in that case, and I don't think they're happy, but I think the fact that the recoveries were pretty full, if not entirely full, more or less diffused the issue, if you know what I mean. And similarly with Madoff, the trustee in that case really didn't have the legal standing to get some of the recoveries that he did, but Mr. Pickard kind of stuck at it, and he bluffed his way into getting some of the banks and others to return funds to the estate so he could distribute them to the victims. And, again, it wasn't a satisfactory outcome by any means, but it was a lot better than people thought. when the process started and the firm first went bankrupt. So I think, you have to kind of look at it in a sense of equity and just say, with MF Global, the creditors, the account holders were made whole. And that ultimately, I think, for a lot of them was enough. They're still pissed off. Don't get me wrong, but I think that's what happened there.
That's interesting. Yeah, there's opportunity costs. I mean, I guess they got their principal back, but some of them had to wait over a year to get their principal back. So
yeah, that's right.
Well, I want to transition now and ask you about Deutsche Bank and the European banking crisis. Do you think then there's going to be large bailouts, bail-ins? How do you think the ECB and European governments are going to potentially deal with this crisis?
Well, the way they are dealing with it, there was a guy named Mario Draghi, as I mentioned before, who was at the Italian Central Bank and who oversaw the banking system, and he very particularly allowed the merger of a bank called Anton Veneta with Banca Monte dei Paschi di Siena. And by putting a bad bank together with a good bank, you always get a bad bank. And this just proves it again. It's the zombie thesis. If you merge a zombie with a living person, you get a zombie. So, the Europeans have a very difficult problem, which is that their economies aren't growing. And it's hard to raise the money you need to fix banks if you don't have underlying economic growth. In the U.S., during the crisis, Sheila Bair, when she was head of the FDIC, basically taxed all of the member banks in that mutual insurance scheme that we refer to as the FDIC, and they were able to fund the cleanup themselves. Other than the rescue of Citi and AIG, the U.S. banking system basically cleaned up its own mess because they had the money, they had the earnings. In Europe, you don't have that. European banks are far less well capitalized. They're not particularly profitable, and there aren't too many of them. You have a lot of big banks because they've consolidated over the years. So they've used interest rate policy and a variety of other tools to try and prop them up. But, when you talk about bail-ins, for example, if I take the existing debt of a bank and turn it into equity, I've kind of window dressed the balance sheet presentation, but I haven't raised any new money for the bank. And in a lot of cases, these banks need new money. They need new capital. So the notion of debt equity conversions or even converting debt, this thing called TLAC that the regulators are so keen on, into equity, that doesn't really help because the money's already left the bank. The money's gone. And if you have a bank that's insolvent, eventually it's going to run out of cash. And so to fix it, you have to go out and raise new funds for the bank, new capital. And this is why the whole fixation on capital and all of these other issues that have caught the attention of regulators are kind of false, because ultimately I don't want to really know, is the bank, particularly well capitalized? Because I'm never going to get to the point of spending the capital. I want to know if it's profitable. I want to know what their loan losses look like. And I want to know if it's liquid. In other words, does that bank have the confidence of the markets so that people will lend them money? That's what it comes down to. You saw the same thing with the automakers during the crisis. The reason the government supported GM and Chrysler was they knew that if one of them just collapsed and filed bankruptcy, that whole market for auto paper would evaporate, and it would have taken all three companies down. So even though Ford didn't need a bailout, they still supported the bailout for the other two companies because they didn't want the bond market for that particular sector to be disrupted. And as it turns out, after the crisis, the market for auto paper came back all by itself. It didn't need any help from the government at all. But it's all about confidence. It's not about capital. That's really the key thing for people to keep in mind.
Yeah, that's interesting. You said the banks doing a debt for equity swap won't raise them any more capital. I don't know if you saw this about a month ago. The Federal Reserve released a weird press release. I saw it on Yahoo Finance. I'm not sure if it was released anywhere else. But they basically said they weren't going to do any more bank bailouts combined with the European Central Bank for American and U.S. banks. But they said they projected that the banks needed about $70 billion more in capital, according to their estimates. But that they said the banks are going to have to make it on their own. The banks are going to have to sell their own bank shares of equity, and then the banks are going to also have to sell long-term bank debt.
That's right. They want them to go out and raise long-term debt that is convertible into equity. The trouble with that is that if you kick the trigger that would make that happen, what you're telling investors is that the bank is in trouble. And almost by definition, a conversion of long-term debt into equity that's required by these instruments would precipitate a crisis. The targets for capital adequacy, I think, are too high, especially in the U.S. U.S. banks are overcapitalized now, and they're not growing. They're not providing returns to their investors, and they're not lending. They're not taking risk loans to support economic growth. That may change under the new administration. Just the change in the narrative, if nothing else, may be helpful there. But if you look at, why is there a scarcity of homes in the U.S.? Home prices have gone up dramatically in the U.S. over the last 6-7 years, and it's largely because there's no supply in the hot markets where people want to live on the periphery of the country. The reason there is very simple. Banks will not lend on development. They love multifamily. They love big commercial buildings because they think they're going to get paid more easily with those kinds of loans. But you don't see banks taking risk on single-family homes. And that's a shame, but that comes right out of the regulatory narrative. And, it comes down to many of the banks we work with. The regulators will just tell them not to make those loans. The bottom third of the population in the United States right now cannot get a mortgage. They're not bankable. And this is in part because the liberals who framed the Dodd Frank Act just decided that those people would be taken advantage of by banks, so best not to give them loans at all. That was the thinking. And I think that's unfortunate. I really do. This administrative state that we've evolved in the United States ultimately undermines our personal freedom. And I don't think it's the business of the government to be micromanaging financial institutions that way. If we held the officers and directors responsible for their actions, we wouldn't have a problem, trust me. If all of those directors knew they would go to jail, you would have good banks. That wouldn't be a problem.
Yeah, you've got a great quote on your website here. The real division is not between conservatives and revolutionaries, but between authoritarians and libertarians, by George Orwell. So I think that's a good quote. These too big to fail banks backed by central bankers, they just create moral hazard in the system. We need bankruptcy for capitalism and free markets. We need bankruptcy. So we got to let these banks fail. People have to, if they commit fraud, they should go to prison. If the firm makes a bad investment, a firm that was more prudent should get to buy up the assets for pennies on the dollar, and the bad assets, either no one buys or liquidated, or maybe they're moved to a large bad bank or something like what happened in the 1980. Now, for Europe, for Europe, do you think then that they would consider bail-ins, because they do need, the European banks are undercapitalized, like you said? Do you think they're going to start going after a large pool of retirement account money and maybe forcing people to buy bank shares or bank debt then?
So far, what's happened is a kind of selective process where there have been bail-ins for the institutional investors, and the politicians have tried to avoid doing that to retail investors because of the political backlash. So, for example, in Italy, the Italian banks 5 years ago lost their ability to sell paper to institutional investors because the institutional investors realized that these banks were in trouble. So they started selling paper to retail investors, and this was debt disguised as deposits. So when they had to do that recent capital infusion to Banca Monte dei Paschi di Siena, the government basically bailed in some of the debt holders, but not the retail debt holders. And that's the game they're playing here. Now, in some cases, the banks may be in such trouble that they'll have to just have a wholesale bailing. But again, that doesn't solve your problem because you still need to raise fresh cash to recapitalize the bank because the money's out the door. When the bank suffers loan losses, that money is gone. And since the bank's only got $1 in capital for every $10 or $15 in assets, most of the money that they've lost belongs to somebody else. It belongs to the depositors and the debt holders. So the bank takes their capital loss but ultimately they have to find the cash to make those other parties whole, or the bank will fail. You know, the customers will ask for their money back, or the bondholders will want their debt redeemed, and the bank won't be able to perform on that obligation. So I think you will see bail-ins, but the real issue in Europe, as I said before, is growth. You got to have more economic growth to make some of these banks work. And, you know, the other issue that they've been trying to deal with in Europe for many years is just the entire legal system, as you were saying before. You know, the whole question of bankruptcy really doesn't work in Europe. If you're a creditor and you have a claim on a building or something of that nature, it can take years and years and years to sort that out. Whereas here in the U.S., you know, the founders of our country realized that having a prompt resolution of insolvency is a good thing. You know, many years ago, I was in a terrible libel litigation with a very powerful businessman in Mexico, and I had to go through a personal bankruptcy, which was how we ended the litigation. But it allowed me to kind of reset and start my life again. And it's a very important right that all Americans have, that right to a fresh start, because it brings things to an end. You know, the bankruptcy process says if you got a claim, file it. Otherwise, you know, off you go. And in MF Global, in the Madoff case, and many other cases, Lehman Brothers, bankruptcy actually worked quite well. It took a long time, and the Lehman process still isn't over. They're still dealing with it offshore. But ultimately, I think it does work to the benefit of the creditors and to society as a whole.
That's a great point. I think, you know, people, if they're good business people like Donald Trump or Jim Rogers, you know, many prominent investors and traders have gone bankrupt before at least once. They learned a valuable lesson from it, and they came back from it and built a business after that. Henry Ford went bankrupt how many times? 3 times before he succeeded with the Ford Automobile Company?
Well, his previous businesses failed. Henry himself, you know, personally didn't go bankrupt. But the remarkable thing about Ford is that the company itself has avoided default, even most recently when, you know, the Goldman Sachs bankers on the Ford board, Bob Rubin and particularly John Thornton, you know, raised $24 billion. They hired Alan Mulally from Boeing, and they were able to restructure the firm without a default. Whereas GM has failed 3-4 times in the past century. You know, it's been a mess. And Chrysler, of course, failed as well. They've come close to failure several times before that. So, you know, it's a tough industry, autos. It's brutal because it's very cyclical. And you've got to carry all of these costs so you can make cars when times are good. But when volumes fall and sales start to decline, you have to carry all of these costs, and it's extremely difficult for them to adjust their cost structure quickly. It's really impossible. So, you know, it's remarkable that Ford has managed to do that and get into the 21st century without failing.
Great point. And they also have to retool their factories, you know, which is one thing a value investor like Warren Buffett, he's looking for businesses that don't have, you know, large capital expenditures, and the auto industry always has large capital expenditures because they have to retool their factory almost every year, right, with whether it's robotics or new assembly lines, and they have to keep updating that. And we have all this expensive automation equipment that's going into the factories nowadays. Our listeners should go, if they want to see the automation and how it's increasing in the auto industry, go Google a video of the Tesla factory, and there's not even that many humans anymore making Tesla automobiles.
Oh, no, they don't want them in the factory. They create errors. It's like the semiconductor business. The entire semiconductor business is basically automated now. The only time they let people in the building is to maintain the machines. You know, you probably remember years ago, Intel used to have those quirky ads with people in the bunny suits. Well, hell, they only let those people in the building now on weekends do maintenance. You have to use robots. It's so expensive, and errors are so frighteningly costly when they occur that it's better to just let the machines do it. You know, that's what it comes down to. Now,
you're undertaking a very in-depth book on Ford and the rise of the company. It was one of the greatest success stories in U.S. history. He created the modern assembly line. His personal, I think, political philosophy, he didn't like capitalism too much, but he was really good at it. So he was good at, scaling things out and innovating and trying what works. And he was the first to pay his factory workers, a higher wage and get them to buy his own products. So he had some successes there, whereas other entrepreneurs in the industry failed.
Well, you've just repeated a number of the great fallacies about Henry Ford that I'll go through them. The book is called Ford Men because I wanted to remind everybody that there were many, many other people besides Henry Ford that were responsible for that success. The Ford family and the Ford PR department have kind of airbrushed the history. So you would think Henry did everything. But in point of fact, when the company was started, he wasn't even an officer. He had such a terrible business reputation, as you pointed out earlier, that his backers had to keep their support for the new venture quiet so that they wouldn't scare their own bankers. That's how reckless Ford had been. He didn't invent the assembly line. That was Charles Sorensen, the great manager of Ford, who was there for 4 decades. Henry took credit for it, of course, because he was a significant public figure, but it was the managers in the background who actually made all of that happen. The key figure was James Couzens, the great senator from Michigan, who was one of the early shareholders in Ford. And it was Couzens who was the one who pushed for higher wages because he was haunted by his wealth. He saw the difficulty in the economic circumstances in Detroit in the 1920s and that earlier period, 1910 to 1915, when he left the company. And he felt badly that he had become so wealthy so quickly with so little effort. I mean, they repaid all the investors in the original Ford Motor Company in the first year. And after that, the profits were just astronomical. Henry Ford, the Ford family, they represented one of the first transformational fortunes in America. It was a fortune built on manufacturing. But it was really a story of many, many people and many serendipities that allowed the Fords to go, for more than 100 years and go into the 21st century the way they have. And there's so many wonderful scholars and writers who used to follow the company, John Kenneth Galbraith and Alan Nevins, this colossal historian. So what I did was just go back through the literature and try and assemble this in a reasonably short format so that people understood it. And then I was able to also add some of my own work at the end. I used to write for the Washington Times, and I did a couple of long magazine articles on the Ford Explorer, which was another interesting episode in the company's history. And then finally, Billy, redeeming his family and saving the family fortune. What's fascinating about Bill is that he's a very decent human being, a very interesting guy, very low key. But the reason that he was picked, as opposed to his cousin Edsel and some of the other Ford family members, to represent the family and to effectively run the company as chairman, and in particular chairman of the finance committee of Ford, is because he's also a Firestone. His ancestors included the old Firestone fortune, and I think that legacy was why he ultimately was picked.
Do you think then a company like Tesla, like Elon Musk's Tesla, is going to be the new Ford, that they're going to put out of business a lot of the large major auto companies like GM and Ford, or are these guys going to be able to adapt to new consumer preferences with electric vehicles and hybrids?
No, I'm not a big fan of Tesla. I think Musk is a great salesman. He's like P.T. Barnum, and he's been able to raise a lot of money. But, the auto industry is an irrational industry. It's an industry where many of the competitors don't make money. They don't cover their cost of capital. The net margins for companies like Ford and GM are way down in single digits. And it just is not profitable enough to support that kind of investment. The other thing, of course, is that I think hybrids, where you have an engine and a battery, are a much better technological solution than a purely electric car. The Teslas are beautiful, And you clearly want to have a DC motor if you can, because it's so powerful and so efficient. But nothing's changed in batteries in 100 years since Edison and Henry Ford collaborated together in Detroit. What's changed is that all the devices we use and the motors are much more efficient, but the periodic table has not changed. And, that's why Edison ultimately told Henry Ford, use gasoline because it's a more compact source of energy. The Germans and others were making electric cars in the turn of the last century, and they had batteries the size of coffins, lead acid batteries. And they were kind of neat. Edison was very much committed to making electric cars, but he didn't have the technology to do it. And I think that, the Porsche Audi Group, Ford, GM, all of them are going to get into this. The Japanese are already heavily into hybrids. They're starting to make pure electric cars, which I think will predominantly be used in the cities. That makes sense because you can plug them in at night. The grid's up, right? You have to keep the electric grid humming while everybody's sleeping, so you can recharge those vehicles. You could just let people have the electricity for free, frankly. But ultimately, I think that Tesla is not going to be successful because the bigger, more efficient automakers are going to kill them. They're going to come after them. I mean, Audi's already experimenting with electricity. They use it in their race cars. It's very interesting. But what we need is a more compact source of electrical generation, kind of like a train. If you think of a diesel-electric train, it's a wonderful combination of the ability to generate DC power and drive the train with DC motors. And they use a gas turbine to make all that happen. We don't have something small enough to put in a car yet, but eventually we'll get there. Maybe some sort of hydrogen power. I don't know what it'll be. But I just think that people have to be careful with these early stage technological innovations. I put Tesla in the same bucket as blockchain. It's fun to talk about, but ultimately I don't think there's any economic utility there.
That's interesting. Now, I know Tesla has record margins for now, although the company's not consistently profitable. I think they have record gross margins, but that was making their luxury model. So now, he's trying to make a cheaper car, which is going to have less margins, and he's trying to democratize electric cars for everyone, but that's a razor-thin margin business. So at some point, I think BMW, Lexus, which Toyota makes, and then also Mercedes-Benz, they're going to make a similar luxury electric vehicle that these rich billionaires on Silicon Valley and other successful people like to show off and drive around. So yes, Tesla has a lead for now. Well,
of course. I mean, think about it this way. You got Google in there. Google is experimenting with autonomous vehicles and spending a lot of money in a way that is almost irrational. They're doing it because they're trying to take a leadership position in a new technology. But, most automakers are constantly under pressure because they're in an industry with chronic overcapacity. There's a number of players who should have disappeared long ago, especially in Europe and in Asia too, and they're still there because their governments support them. The Koreans subsidize their car makers heavily. You have car makers in China now. And in these countries, the imperative is employment. They don't really look at whether the enterprise actually makes money. So if you're Bill Ford or the people at GM or the folks at Daimler, you're dealing with an industry where there's three basic models: compact, mid-size, luxury. The luxury end, you make money. Not a lot of units, as you pointed out, right? But nice margins. The mid is kind of so-so. Some of them are profitable, some of them aren't. And in the low end, where all the volume is, they don't make money on those at all. In fact, the dealers only make money, real money, on service and parts. But if you look at, just the sales of smaller vehicles, there's not that much juice in them. They make more money on used car sales than they do on the new units. And now that volumes have slowed down this year, kind of that last quarter of last year, you all of a sudden started to see the incentives again. GM is addicted to incentives to drive volume because they know that if their enterprise gets below about 75% utilization of the plant, they're not making money. their costs overwhelm them because the costs don't scale with the volumes. The costs are fixed. The big thing that Ford did was they lowered their break even dramatically. Alan Mulally took a lot of cost out of their operation so that they could survive at lower sales volumes. But again, they're competing with companies that are largely irrational. Look at, the Nissan Group with Renault and the rest of them. Should they still be here? No. They're kind of also rans. So,
and those countries like Japan and South Korea, they put huge tariffs up on trying to import American automobiles. So that's not a free market either. So the U.S. doesn't have, tariffs really on imported automobiles from other countries, but other countries have high tariffs on American imported automobiles. So it's not fair competition, though. I want to ask you, though.
Historically, Ford was the spoiler. They were a mono brand for 80 years. Lincoln never had big volumes. They were compared to Chevrolet for most of the 20th century because they were so much smaller. And then GM and Ford was always an entry-level product. They never really had that range of different brands that GM had accumulated. So, go ahead. I'm sorry.
My last question before I let you go in the interview, subprime auto loan bubble. So we have a lot of people who don't have very good credit right now and are basically getting, no down payment, low interest loans, or if maybe they don't even have to make payments for a couple years to drive a brand new car off the lot. Do you see a very large auto loan bubble here in the United States now?
Well, the proportion of below prime auto loans versus prime is about the same as it was 10, 15 years ago. The market has grown a lot since the crisis. Market for auto loans has doubled since 2008. For your listeners, Kroll rates a lot of below prime auto loan deals. If they're interested, they can register on the website and get into the minutia of asset-backed securities. Clearly some of these loans with the longer tenors, when you get out 7, 8, 9 years, you have to wonder, is the car going to have a useful life that long? Probably not. But again, I think that the automakers, particularly the low-end players like the GMs and the Chryslers, they drive these sorts of sales. Some of the Asian automakers, too, the Hyundais and the others, we can't even pronounce them, they just want to sell. And so they will give credit to anybody who's got a pulse, and, they just count the sales and they don't worry about it. I don't think it's a financial market problem because your typical asset-backed security that has auto loans in it has a very low advance rate. In other words, they have twice as much collateral inside the trust as they need to pay off the bonds. So the bonds have actually tended to perform really well, and investors have been okay. The automakers, the finance companies who sponsor these deals, that's another issue, and you could see some problems there down the road. But I think, the reality is that for a lot of millennials, a lot of younger people in the U.S., the car is the major purchase. They're not buying homes. So if they live outside the city and they need a car for work or for whatever reason, that's really the focus. And that's why the market financing has, changed and evolved to accommodate that demand. But look at last year. We had a record year in the U.S. We did 18 million units. It's really quite remarkable. And a lot of it was driven by finance. I think you're right that way. But I would be careful, characterizing it as a bubble because it's not a 30-year mortgage. You're talking about a loan that's collateralized by an asset. If the obligor gets 2 months behind, they're going to come and repossess the car, turn around and sell it. So the recovery rates on auto loans tend to be pretty high. And, as a credit, most auto deals have 2 to 3 year average lives, if you look at the bond market. So again, it's not a 30-year mortgage. It doesn't have all the legal issues that go along with a mortgage. And it's, for that reason, it's viewed as a superior asset class by investors compared to, say, residential mortgage-backed securities.
So you don't think then that the depreciation of a car when you drive it off the lot, so the value of a brand new car is what, 30% higher than as soon as you drive it off the lot? You don't think then that affects the loan values then of these auto loans that have been packaged?
It can, but remember the bid until recently. There's been some softness in the secondary market for used cars in the last 6 months, but up until then, if you repossess that car, you might take a 20-30% loss, like you're saying, and then just turn around and sell the car. And so your recovery rate on that loan is still pretty acceptable. That may seem crazy, but in the grand scheme of things on Wall Street, if you compare that to leverage loans and junk bonds and all the rest of it, auto paper tends to be viewed as pretty high quality because the maturity is so short, right? You do have an asset that's very easy to find. It's not like you have to go file foreclosure proceedings against a house. You just go and take the car. I mean, the sponsor has the right to repossess that vehicle immediately. So it's easier to resolve, and that's, I think, the key issue.
I see. And there's also, GPS and LoJack now in the car, so it's even easier to find that now.
Oh, sure. You put it in the garage, they'll pull your garage door off and take the car. Trust me.
Well, this is making things interesting nowadays with the loan portfolio, because when you see the loan book of something just grow so quickly, people just assume it's a bubble. We'll have to see what happens though going forward. I mean, I am worried though about the European banking system because there's a lot of American banks that have so much exposure to Deutsche Bank and others in the derivatives market. Deutsche Bank has $40 trillion in gross derivatives exposure.
Well, they've been selling some of their positions. It's interesting. Credit Suisse sold a big book, and Deutsche sold a big chunk. In both cases, I think Citi was the buyer. Citi's now got a bigger derivative book than J.P. Morgan. Think about that. I'm actually much more concerned about that than I am about Deutsche. I had to defend Deutsche last year because I got off a plane in Dublin and I found out that Angela Merkel had thrown him under the bus, and I thought, politicians, it never fails. You never talk about a bank when it's open. That's one of the things I learned working in the regulatory community. And to have the head of the German government say she wasn't going to support the biggest bank in the country, I thought was a little bit intemperate, but there you are. Anyway, it's a pleasure talking to you.
Now, Chris, I want to thank you again for your insights. If our listeners want to follow your work, I know you're on Twitter. Where else can they follow your work, your articles, anything else you put out in public?
Well, yeah, Twitter is RC Whalen, and the website's rcwhalen.com. I publish research here at Kroll Bond Ratings. Obviously, you can register on their website, and that's about it. The book Ford Men should be up on Amazon in about 2 weeks. And we've got another book coming later this year called Good Banks, Bad Banks. That should be very popular.
Excellent. Well, we'll have you back on to talk about the banks again. There's just so much controversy there. So it's definitely an interesting topic now, considering I think, we're not too far away from another financial crisis, unfortunately.
Well, maybe not. We'll see. I still haven't found out where the hidden leverage is. I'll let you know when I find it.
Okay, great. Well, thank you for your time, Chris, and I enjoyed the discussion.
Yep, thank you. Look forward to seeing the interview. I'll put it up on Twitter.